The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Tariff man digs in, and some people in the market are bailing out. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the United States. It's been a choppy trade.
It's a crazy day.
It's a crazy one. We're going to show you exactly what the major indexes are doing. The S&P 500 roughly flat on the day. The NASDAQ 100, there's a little more love, but it's losing it. Very interesting here. Even the green is a little bit deceptive because Tesla, Nvidia might be up, but a lot of the major tech names still down on the day. The 10-year has been interesting. The yield has been drifting higher over the last week or so. Now about another 3 or more basis points higher. We are back above 4.4%, more importantly. The dollar also have been watching this throughout the day, Romaine. Very, very interesting. It was on its second day of gains. It's losing that as well. Yeah,
a great board there because it really does show the stasis in markets, a market that early in today's session had actually seen an opportunity to try to rebound from yesterday's tariff-induced sell-off. But President Trump, in his latest posturing, making clear he's serious about following through on his trade threats. He did, though, extend the deadline for negotiations from July 9th to August 1st. But then again, that just kicks the can down the road, which means for a lot of folks in finance, prepare to spend less time at the beach this summer and more time at the office.
I think we're in for a choppy summer. I think no one's going to get the free break that they were hoping for in August. There's going to be a lot of negotiations. There's going to be, I think, a lot of deals struck. And we continue to see this administration use these tariffs as tactics and as tools. And that does not appear to be changing.
All right. And not only are the tactics not changing, but they are continuing to evolve. Trump in a cabinet meeting today said he's also moving forward with those separate Section 232 tariffs that target specific products. That includes a crippling 200% tariff on foreign-made drugs and a 50% levy on copper, which is double what the president had mused about just 3 months ago. In fact, front-month COMEX copper futures settled 13% higher in New York at a record $5.65 a pound today, a startling reminder that betting on Trump's bark being worse than his bite is not as sure of a thing as some would believe. So if there's any big takeaway from the past couple of days, it's that tariffs appear here to stay, Sonali, and so too does the market volatility.
I have some different alliteration for you this afternoon.
I love alliteration.
We have titans and tulips here, according to Bloomberg Intelligence.
Wow.
You were talking about tariffs. Gina Martin Adams had put together baskets of the least tariff-exposed stocks and the most exposed. The least exposed have truly rallied. If you take a look at it, it's up almost 19% since the beginning of February, almost 20%. But the most exposed, these are companies like HP, Bristol Myers, Best Buy, Merck. They have not only trailed, they are still down almost 5%, despite a rally here since the April lows. So we will keep an eye on just how much these guys can catch up as we head toward that August 1st new deadline, Romaine.
Certainly an August 1st new deadline with the markets near record highs and a lot of questions for investors as to how you allocate, if at all. Abby Yoder joins us right now, U.S. equity strategist at J.P. Morgan Private Bank. Kicking us off to the close. Great to see you, Abby.
Great to see you.
A few days ago, a lot of folks were celebrating the big, beautiful bill and some of the potential economic upside that might provide. And of course, over the last couple of days, they have a reminder that there are still a lot of headwinds to this economy, particularly when it comes to trade and tariffs. I am curious as to how you see this potentially playing out for the markets. Is this an investable opportunity, or is this one of those situations where you have to sit on the sidelines and wait for things to shake out?
I mean, so we definitely think it's an investable opportunity. I think, to your point, there are different headwinds and tailwinds that are happening kind of at the same time, which is what we've been talking about for the majority of the year, right? The focus for the first couple of months was really on those growth negative policies as it relates to immigration, tariffs, what have you. And now that the reconciliation bill is through Congress, I think, and signed by the president, I think the focus will turn back to the tariff noise. And the expectation for us is that these stay between 10 to 15%. Like in our base case scenario, we still have them at those levels. And right now, the effective tariff rate is something like 8%, just based on what companies have been doing to kind of maneuver around the tariff rates. But we do have that 10 to 15%. It's really about the resilience in corporate America that stands out to us and why we're still bullish going forward.
Well, that's what I'm curious. I mean, earnings season, ostensibly, it actually starts this week. I think we get Delta on Thursday. And then, of course, next week we get the big banks. And there's going to be a lot of questions about not so much what happened in the past quarter, but obviously the guidance and the commentary on the conference calls. Do you have confidence that not only will the bottom lines for these companies and margins and things like that will actually hold up, but more importantly, that the CEOs, CFOs will be confident enough to guide maybe potentially higher for the rest of the year?
Well, what was interesting is coming into 1Q, we actually thought it was going to be similar to what we saw in March 2020 when you saw a lot of companies, or April 2020 when you saw a lot of companies just pulling guidance, right? And you really didn't see that. Only 1% of companies actually pulled guidance. They really did try to come up with a framework, how to think about what might happen, different scenario analysis. And I would say in terms of like your question around what happens with the bottom line and what happens with guidance, I think 2Q is going to be really important because it's going to be the first real time that we actually see the effects of tariffs. But expectations are really low. 2Q earnings expectations have been revised down. Earnings have been revised down north of 4%. Historically, it's something closer to 3%. And that's really coming from margin contraction. And I think, I think a lot of corporate America will show that they're much more profitable than expected.
How are you thinking about this across sectors, especially as we get closer to those 232 tariffs? Those were really the big question mark, weren't they, for so long? Are you willing to make bigger bets on areas like pharma, for example, which has underperformed, still negative on the year, but might now have a little bit more time to work through these tariffs? So pharma in particular is, it's kind of a hotbed of policy risk right now. It's not just the sectoral tariffs, which were thrown out, like you mentioned earlier, 200%, whether or not that's true. And he did give them leeway in terms of like a year and a half to implement and work around. But they also have drug pricing on the, most favored nation being thrown out there. So there's just a lot of things going on for that sector in particular, where no matter how attractive the valuation looks at current, trying to get the right earnings number is really difficult. So whether or not that valuation is actually correct is difficult in this environment. The headline risk, just generally, that goes through August, maybe longer. Does the market feel frothy in some corners, given the run-up we've seen since the April lows? Well, I mean, at north of 22 times, yeah. I mean, it's a little bit hard to defend, right? We're back to basically where we were at the beginning of the year when we were at previous all-time highs. So it becomes a little bit harder from a valuation perspective. And in our base case, we do have valuations coming down to like 20.5 to 21 times. So we do have them coming down. But that doesn't mean, this is a strong momentum market, and there's a lot to be excited about.
I know we're focusing a lot probably when we're talking about these earnings estimates on the S&P 500, but I'm curious your thoughts more on the small cap space. We're seeing over the last few days, we've seen several sessions where we've seen meaningful outperformance in the Russell, in the S&P 400 mid caps, and some of the other indexes that track, I guess, some of the more cyclical or economically exposed stocks. And there does seem to be maybe a little bit more optimism, or is that just more about lower valuations relative to the large cap brethren?
I think there's an element of positioning that plays into valuation that's obviously a driver there. But I think last week in particular, what you got was a confluence of, better than expected inflation data, a more dovish Fed, like in terms of speak, and then, a relatively strong labor market report. That's a pretty strong backdrop for cyclical assets, right? And it feels like the market really does want to get involved with the cyclical side because, again, it's so unloved from a positioning standpoint. But right now, I mean, rates are, like you said, they've been inching back up, 10 years north of 4.4. I think that's the real risk for cyclicals and for small caps in particular.
All right, Abby, great stuff. Abby Yoder is U.S. equity strategist with J.P. Morgan Private Bank, kicking us off to the close here on this Tuesday afternoon. A lot of stories we're watching, including Meta taking a minority investment in one of the biggest makers of glasses and a new valuation for SpaceX. But when we come back, we continue our conversation on tariffs and taxes and how it's impacting the heart of the U.S. economy, small businesses. Matthew Luzzetti, chief U.S. economist at Deutsche Bank, he joins us next, right here on The Close on Bloomberg.
NFIB, small business optimism ticking lower in June on worries around the tax impact of President Trump's so-called Big Beautiful Bill, signed into law last week. Nearly 1/5 of small business owners flagged taxes as their top concern. the biggest share in almost 4 years. Let's bring in Matthew Luzzetti. He's the chief U.S. economist at Deutsche Bank. When you look at the tax bill, a lot of people have already been pointing out the disparities between lower income Americans, higher income Americans, and who benefits more. How does that play out between smaller and bigger businesses? If bigger businesses benefit more, then what kind of chance do smaller businesses that really drive the heartbeat of this economy have?
Yeah, I think you certainly see that in the data. And first, from a consumer perspective, you see across the income distribution, a lot of benefits are going towards the upper part of the income distribution. The spending cuts that are happening for Medicaid, SNAP, and those items are more than offsetting the tax cuts at the bottom part of the income distribution. You know, as I looked at the NFIB data today, it was absolutely interesting that there's concerns around taxes, given that tax cuts are being delivered. I think that probably also reflects cost pressures that are there from the tariff side. Tariffs are certainly leading to increased cost pressures. And while I don't pay as much attention to the top line number in terms of optimism, it surged in November, came back in April. I think some of the underlying details are really interesting. The employment components have been really stable in recent months. And you actually see that they're planning to increase prices at the highest level in several months.
So when you think about the overall administration strategy, of course, tariffs is guiding a lot of the discussion for today, certainly will be the case for the rest of the summer. What is the Deutsche Bank playbook? How do you do the new math every time the president makes a new statement?
Yeah, so I think what we've learned is we don't want to change our forecast once we get announcements, and we want to see where everything settles. And so we didn't really change our forecast all that much after the April 2nd announcements. We thought that they would kind of pull back, and they did. At the moment, I think we're taking the same approach, where if you were to take literally what they're announcing on the tariff side, you would increase your inflation forecast, probably mark down your growth forecast. That would have offsetting views for how we think about the Fed. But if you just take the announcements yesterday, that would add about 1.5 percentage points to the average effective tariff rate. That would probably add about 15 basis points to inflation over the next year. If you were to then add on top of that copper pharmaceutical tariffs, that adds substantially to our view on tariff rates.
It's kind of interesting, too. We talk about this, and I know as an economist you have to map this all out, but we're still kind of somewhat in the theoretical phase of all of this because a lot of these things haven't taken effect. But there are other things outside of tariffs that are also, to a certain extent, anecdotal or theoretical that have impacted the economy, including immigration policies. And I am curious as to how you try, if at all, to model that in to try to determine exactly maybe where the activity is and, more importantly, where it isn't.
Yeah, a lot of the shocks that we're seeing for the economy, these policy shocks, certainly if you look at immigration and trade, are what we call adverse supply shocks. They tend to reduce growth and lift inflation. Immigration, I think, has come into increasing focus, given some of the policies that we've seen, but also through the lens of the labor market, because how we view the jobs report each month is going to be different with immigration flows being curtailed. As an example, I think a new normal for the monthly job numbers that we see is probably somewhere between 50 and 100,000. If you go back to last year, kind of the monthly break-even payroll number was above 200,000.
Yeah.
And so another way to say that is to keep the unemployment rate steady, you probably only need 50 or 75,000 jobs per month being added.
Is there a case, a legitimate case to be made, at least in the minds of an economist, for cutting rates now? And I say that because the Trump administration, Trump himself, I should say, has really been beating that drum. In fact, just a few seconds ago while you were speaking, he's out with another social media post. Cut interest rates, Jerome. That's a direct quote here, so maybe a softer tone than what we've heard in the past. But it gets to this idea, I understand why he wants this, but it gets to the idea of whether Jerome Powell and the other Fed members could even make a legitimate case either at the July meeting or at the September meeting to cut rates.
I think it's unlikely. And if you look at it, Chair Powell has stated that if it were not for tariffs, they may have continued with rate cuts. I think if you just look at the economy and take a step back and look at their dual mandate, the case is not clear at all. Core PC inflation is 2.7% today. It was 2.7% a year ago. It's actually a little bit higher than it was a year ago. Over the first 5 months of the year, core PC inflation is up 3% annualized. The unemployment rate is 4.1%. It's below what the Fed thinks maximum employment is. There's no case from a dual mandate perspective for the Fed to be cutting rates today. I think the economy is actually very consistent with a much higher neutral rate, that the economy can just operate, be more resilient with rates at these levels.
To square this circle, you have the president saying in that post that he's looking at a recent study by Stephen Myron, chair of the Council of Economic Advisors, saying the same thing that Scott Bessent, the Treasury Secretary, said on our network last week, which is there's no impact from inflation from tariffs, right? There's no inflationary impact so far. How then do you take the Wall Street math against the Washington math?
So I think I would generally agree with that assessment, which is if you look at the inflation data so far, there's not a clear big inflation impact. But that's actually more concerning because it tells you even before the tariff effects, inflation was stuck at higher levels. core PC inflation was at 2.7%. We still expect that those tariff effects are going to happen. Next week, we expect to see a 0.3% core CPI print. If you look at some of the leading indicators, the PPI has already been showing some of the uplift. That tends to take a little while to filter through into the CPI data. So we think it's going to happen. Obviously, there's lots of uncertainty about the timing and ultimate impact, but we still think that those effects are to come.
You think you're going to get a summer break this year?
I'm not as hopeful as I was a few months ago, unfortunately.
All right, Matthew Luzzetti, Chief U.S. Economist at Deutsche Bank. As we continue here on The Close, counting you down to the bells, a conversation up ahead about what's going on in Washington, because that, of course, is what's driving Wall Street. Lanchee Chen, David and Diane Steffi Fellow in American Public Policy at the Hoover Institution joins us next. This is Bloomberg. All right, let's get a quick view from the sell side with our top calls. Big movers on the back of analyst recommendations with a big focus on Washington driving the Wall Street story. We start with KeyCorp. UBS upgrading the regional bank today to buy from neutral and boosting the price target to $22. The analyst saying that that company will be an outsized beneficiary now that the, quote, worst case scenarios on the economy from tariff policy are off the table. We should point out that note was published before today's developments. The shares up about 1% on the day. Next up, Sunrun. KeyBank, the sell-side shop over at KeyBank, raising the solar stock to sector weight from underweight. The firm also boosting Solar Edge to sector weight, citing easing regulatory risk. This after a provision denying investment tax credits to leased equipment was modified to exclude solar in that big, beautiful tax bill. Nevertheless, you see the shares down about 11% on the day, and those are some of our top calls. We do want to stick with this theme, though, the intersection of Washington policy and Wall Street action, and bring in Lanchee Chen. He's a David and Diane Steffi Fellow in American Public Policy Studies at the Hoover Institution at Stanford University. I'm pleased to say he joins us here on the East Coast in New York.
Great to be with you. Thank you.
All right. We have to start talking about some of these developments that we've had just over the last few hours, because we mentioned that one call. Obviously, the analysts last night, it did look like maybe we had some tariff certainty or tariff clarity. We have a new deadline. July 9th is now August 1st. We have maybe potentially new tariffs, 50% on copper, maybe 200% on pharmaceuticals. What exactly is the negotiation tactic at this point, in your view?
Well, I think if we could answer that question, we'd all be, in a different line of business, different line of work. I think there's a couple of factors at play here. First of all, the president has been committed to tariffs for his entire political career. This is not a new position. We all know that. That desire, that interest is meeting the reality of how markets have reacted to the more extreme tariff positioning. So I think what you're seeing is a little bit of a real-time negotiation. The administration is trying to work out what is feasible, what is possible. And of course, most of these negotiations are multi-sided. So if you think about the Japan negotiation, the Korea negotiation, if we were having this conversation in April, we would have said those are going to go really well. Well, now we look at those negotiations and we're not so sure. Europe looks to be going well. We never would have guessed that. So there's a lot of real-time adjustment, I think, that's happening here as the president approaches these questions.
And there's been a big betting game in markets, this idea that he either wasn't serious about this, that this was just a negotiating tactic. But I just want to draw your attention to something he said at his cabinet meeting that he had earlier today. He went on a very long rant about McKinley, of course, who he's mentioned before as having been some sort of inspiration for his own tariff policies. And he talked about the policies of his successor, Roosevelt, and the idea that a lot of those policies were paid for by the tariffs that McKinley imposed. Now, I have no idea historically if that's true or not, but it does get to his thinking that maybe this isn't just a negotiating tactic. Maybe he truly does see at least some level of tariffs as necessary to fulfill his policy dreams.
Yeah, there's no question, Romaine, that some of this is about a philosophy, about what the American economy should be. And if you look at it in that whole, if you think about a philosophy that says we need to manufacture more here, we need to figure out how to promote a middle class with a certain kind of set of jobs, then it all kind of makes sense. I think the challenge is that the policy at various points has been sometimes about readjusting the economy, other times about being punitive, other times about just trying to get a deal. I think that what the White House needs to do is to put a little bit more of this philosophical underpinning into what they're doing, because that will help market participants understand this is what the end goal is for the president. I think the challenge is the president himself likes to use tariffs in all of these different ways. And there's not necessarily a singular consistency around why these tariffs are being put in place.
Well, let's just take one, manufacturing. How do the sectoral tariffs compete with that objective? Because if you're trying to make this a manufacturing economy, then wouldn't sectoral tariffs make the inputs much more expensive?
Yeah, and look, there's a big challenge here, right? Because if you look at some of these sectors, let's just take pharmaceuticals as an example, since we talked about this 200%, which I don't think is ever going to happen. But think about how hard it is to move parts of that supply chain back into the United States. Is it a noble goal to say we should be producing more in America? By the way, we do a ton of R&D in America. Yeah. We do a ton of innovation in America. The fact that we don't do the production in America, there are some downsides to that. We saw it during COVID. We saw some of the supply chain issues. But the idea of reshoring that whole supply chain is incredibly challenging. So we probably won't ever get to that point. The question is, how far along is far enough along? So these sectoral tariffs, some of them to me make a lot more sense than others. Pharmaceuticals, I think, are more challenged. But if you start to look at some of the commodities that are being tariffed, for example, maybe there's more of a case there.
Because you have the experience in this space so deeply, beyond the tariffs, the tax policy, how is that going to play into the midterms when you have a lot of low-income Americans and a lot of Americans losing Medicaid access in the next couple of years? What does it mean in terms of how they're going to show up to vote, especially when you have another billionaire in the corner trying to form a new political party and really influence the outcome of what this Republican Party looks like at the end of the midterm?
My own view is Republicans need to do a better job of selling this thing. In other words, this is really about tax relief for all Americans, many of whom are in the middle class. This is about how the tax system really needs to be oriented for the U.S. economy to be more competitive. And frankly, if they didn't do this tax bill, if they didn't get this across the finish line, the implications for the markets would have been significant. The implications for the American people would have been significant. So this was a must-pass piece of legislation for a lot of different reasons. Now, the Medicaid piece, the SNAP piece, those are things that politically Republicans are going to have to deal with. They're going to have to figure out how they message those issues, how they talk about those issues. But the midterm elections, that to me is the most interesting part of this big, beautiful bill now, is now that it's been passed, how will it play politically? What does it mean for Republicans trying to retain control of both houses of Congress in some congressional races that'll be very tight?
You know, really interesting here, and within just 30 seconds, how do you feel about the prospects of the party coming out of the midterms? Do you think that Americans do like this bill, very simply?
I don't think Americans know what's in it, really. So I think it's incumbent upon Republicans.
It was long. A lot of senators did.
I'm not sure people who voted on it knew what was in it. But it's incumbent upon Republicans to make the argument for it, and Democrats will make the counter argument, and we'll see who wins. The thing about politics is we have a result to point to, and the midterm elections will be definitive in that regard.
Lanchee, Chen, David, and Diane Steffi Fellow in American Public Policy Studies at the Hoover Institution. We thank you for joining us here on set. And coming up, we're going to talk about Amazon. Amazon Robotics deployed its 1 millionth robot in the lead up to Prime Day, which kicks off today. We're going to speak to the Vice President of Amazon
there are 1
Robotics.
million of these things walking around somewhere?
I guess so. We could ask Scott Dresner. He could tell us just how many and exactly what they're telling people to find those discounts remain.
I've seen a movie about this. Did not end well.
This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Sonali Basak. We're looking at a choppy trade as the president outlines his tariff strategy. He says August 1st is the date. Let's see if that sticks.
Yeah, and you have a market that's really kind of been in stasis, at least in the broad large cap space. The S&P 500 unchanged. Biggest drag on the S&P, believe it or not, is actually coming from Amazon today, and that's despite the fact that they're kicking off this 4-day Prime Day, as days, just Prime Week. They should just name it Prime Week at this point. Obviously a big shopping event for them, where a lot of discounts offered by the sellers on the platform. And of course that means a lot of work for all those workers in those warehouses and maybe some of the non-human workers.
Yeah, the robots. Yeah. I want to see how the robots are being put to work. And as Romaine was saying, one tool Amazon is using is robots. Joining us now to discuss those robots, Scott Dresner, Vice President of Amazon Robotics. We were talking a little earlier about how you've deployed your 1 millionth robot. And on a week like Prime Week, if you'll give us the liberty to call it that, how do you see these robots really taking off to meet demand? And do you see them carving new ways for you to start serving customers?
Yeah, so super proud of some of the accomplishments we've had here in the robotics team. A big part of what's happening is part of a super important 4-day Prime Day event for us today. One of the things that we know is important to our employees is to have a safe and productive work experience. Obviously, the robots that my team works on are aimed at providing them with the tools that they need to deliver on a really big Prime Day that we're looking forward to and just kicking off here on this first day.
How strong are these robots? As you're developing them too, ultimately, how much weight are they supposed to be carrying?
Yeah, they can. Each one of those robots can lift over 1,000 pounds, right? So one of the things that they do, as you can see here in some of the videos, is they move our mobile shelving pods around. That's great because that means it eliminates walking for our employees. So they might have to walk many steps through the warehouse every day. The robot can help them do that, and some of the mobile robots that you see here in the video are doing that. We also have manipulating robots, robots that can do things like pick up customer orders and sort them and pack them into containers. And that's, again, great for our employees. It eliminates some of the repetitive motion, some of the heavy lifting, and provides our employees with that great work environment and a safer work environment for them and delivering a big day like today as part of Prime Day.
I'm curious if you could kind of talk about also the evolution of this. Obviously, your perch at Amazon was largely through an acquisition, a robotics company that effectively really did transform these warehouses. I think that is just a fact. It's not an opinion. When you talk about just the efficiencies and being able to find things, bring them out to the workers to pack up and move on. But that was quite some time ago. I think 2012, that acquisition was, so more than basically a dozen years ago. And it now raises a question as to what's the next step, Scott? I know we've talked a lot in this program about humanoid robots, robots that are a lot more functional than just those low squat things that we just saw rolling around on the screen there. How far do you think this actually goes?
Yeah, we think the sky's the limit here, right? I think we have a great opportunity ahead of us, taking some of the types of robots that we have today. So those are the mobility robots that again we've seen moving products around, the manipulators that we see moving products and packages around our facilities. These are great tools for our employees, again, to keep them safe, to keep them productive, and provide them with a great work environment. You mentioned humanoids. It's a question we get a lot. It's an area we're interested in all different types and form factors of robots. But again, there's a lot of space in between the robots that we have today and the humanoid robot. And we think that one of the most important investments as part of that is a little less about the physical embodiment of the robot, but how important artificial intelligence is going to be as part of that, right? This is something that is really helping us make the robotic experience and the tools that we provide to our employees better again for their work environment. The robots can be smarter, more intelligent, and help them collaboratively in the roles that they're doing on site.
So we'll explain a little bit more on the AI side of this, Scott. So we're talking now, I mean, basically the robots that you have right now effectively do whatever you tell it to do. Is the idea that you think it can evolve to the point where they can make decisions on their own? Is that an overstatement?
Yeah, I think what we're excited by is the ability of, if you think of what we do in an Amazon environment, we have to deal with a huge variation of products. We sell 300 million different types of products, and to have a robot that can deal with that variation requires an intelligence that's not commonly found today. And that's one of the places where we're really excited that artificial intelligence can help build and extend the capabilities of our robots, just dealing with the huge variety of things that we see in the types of environments that we have in our warehouses. Again, aimed at helping our employees really deliver a great experience to our customers, finding the price and the selection that they want off our website.
What's the math like? At the end of the day, are there very specific cost savings you can see from using these robots?
Yeah, I mean, obviously, like I said, our first and foremost, we're focused on safety. We're also focused on productivity, making the work experience of our employees even better. We're super proud of some of the new jobs that it's creating and for our employees as well too. One of the ones I love to talk about is you can imagine as we put more robots into our warehouses, we need people like car mechanics, right? And they're robotics maintenance technicians. And these are places where we're investing a lot in upskilling our employees to develop new skills to deal with this new robotic world.
I'm curious, Scott, where are you able to make these robotics? There's obviously been a lot of talk in Washington, of course, about reshoring a lot of manufacturing. And I know that some of the projects in the past that Amazon has worked on in this space did rely on domestic manufacturing to some extent. Is that a big part of what you're using right now?
Yeah, Romain, I'm glad you asked that question because I'm actually sitting here in a facility outside of Boston, Massachusetts. We have, I just came up from the robotic manufacturing facility here where we actually built the millionth robot that you talked about earlier. A great opportunity, great team, an advanced manufacturing team here that has actually built all the mobile robots that we have in the worldwide network today, right here in the United States.
Scott, we thank you so very much for joining us today. Very best of luck as you continue on through the rest of the prime days ahead. That is Scott Dresser, Vice President of Amazon Robotics. Now, we've got a scoop on SpaceX. The company is planning to sell shares from insiders at what could be a $400 billion valuation. Bloomberg's Ed Ludlow here with more, joining us live from Sun Valley, Idaho, covering the annual Allen & Co. conference. Missing you, Ed. Usually like walking around with you and bugging all the billionaires to see what they are up to. When it comes to SpaceX, it's really interesting. The investor base is very broad and wide. Right. What do we know about the latest financing?
Yeah, so around $400 billion valuation, maybe greater than $400 billion. Right now, the share price being discussed is $208 to $212. There's still a little way to go. It could change, but it's quite a jump from the last valuation that we reported of $350 billion. Part of that reflects, of course, not just SpaceX's position in dominating commercial launch, but the Starlink component as well. And you talked about the investor base, like you have some of the biggest names in private growth equity and venture capital and the bigger family offices in this name. But the other investor appetite, the broader part, is on the hope that in the next few years, there might be some kind of spin-off of that Starlink business, which continues to grow robustly.
I mean, I have to ask you, Ed, I mean, there's been so much discussion over the last couple of days about Elon Musk and his leadership role at Tesla. I am curious as to what the leadership roles look like right now at SpaceX. I know as a figurehead, he's certainly prominent, but most of the work there is not necessarily being done by him.
It's a really good observation. And when you think about the mechanics of this round, which, by the way, is basically a concurrent primary, very small primary round that sets the price, then a much bigger tender or secondary, which gives employee liquidity. That is something that's overseen by the CFO of SpaceX, also Jared Birchall, who runs Elon Musk's family office, in coordination with the rest of the Treasury team there, and the board. Met very recently and talked about this. Of course, the structure of SpaceX is that they have Gwynne Shotwell as president and essentially COO running day-to-day operations. But I do increasingly hear that, Elon Musk turns up when it matters at the big moments. We saw him speak publicly about Starship at the last attempt. It does beg the question, could the valuation have been higher? I had heard at various points in recent weeks a much higher valuation was discussed, but obviously Musk right now is very focused on his, what should we call it, tit for tat with the president.
I, in a conversation with one of the banks, for example, that works with their clients on buying some of these shares, I'm hearing that it's one of those things nobody wants to let go of. So it's something where the stock becomes in very short supply. The valuation has just absolutely skyrocketed. How does this compare with the rest of Musk's empire? Because obviously we're not seeing the same kind of love in every stock, if you know what I mean.
Yeah, it's why I think the mechanism is very interesting, right? This concurrent, very small primary, the sale of very limited number of new shares to set price and valuation, the main thing being the tender for employee liquidity. But as we've reported on, it really is a matter of who you know. Do you know Jared Birchall, who runs Elon Musk's family office? Do you know the CFO at SpaceX and Gwynne in order to get in on those rounds? Similar structures at XAI. XAI has used debt and primary or fresh equity raises, and secondaries have played a part across Elon Musk's empire, and then you have the Tesla public component. But again, the demand on the secondary market for this name is so high all the time. It's almost a liquid market when you take into account SPVs and block sellers, things like that. But it is still hard to get, and it's hard to get in.
Yeah. All right, Ed Ludlow there, of course, the news there, the new valuation for SpaceX, which continues to shoot towards the moon or maybe to Mars, around $400 billion in that buyback. Some breaking news crossing the wire while he was speaking. This coming out of the Supreme Court backing President Donald Trump's effort to drastically reduce the size of the federal government. Remember, a lot of those cuts that came earlier this year, primarily out of those DOGE efforts, had been blocked by a lower court judge that went to the Supreme Court that has now cleared the federal government to continue forward with slashing the workforce at least 19 federal departments, potentially affecting hundreds of thousands of jobs. All right, we do want to get back to markets as we continue to count you down to the close. Just about 18 minutes to go until we get there. And one of the big movers on the day is Datadog, down about 4%, worst day going back to April 4th. This after Guggenheim cut its rating on the stock to sell, citing its fraying relationship with its largest customer, OpenAI. The analyst writing that OpenAI may have already started to move off Datadog for log management onto its internally built solution. Mandeep Singh is the global head of technology research at Bloomberg Intelligence, and he joins us right now to explain what the heck is going on.
Well, I mean, Datadog is one of the category leaders in this observability market, and think of observability as a must-have tool. If you have a large cloud infrastructure, you need to monitor the infrastructure to make sure, it's up all the time. So in the case of OpenAI, I mean, we have seen the exponential growth OpenAI has had, and that has resulted in almost $100 million Datadog bill.
Yeah.
The consumption has increased to that extent where they have to decide, are we going to keep paying $100 million on a recurring basis or bring that in-house? And that's what I think the call is about, that they will eventually end up bringing that in-house.
Yeah.
My sense is this is not a new category like a coding agent where OpenAI will develop a product and sell it to B2B customers. So this is more for internal cost controls. But
well,
who
how
knows?
far can the relationship with OpenAI go in terms of helping support Datadog, its valuation, its potential in the future? Because sprinkling OpenAI on companies has been like sprinkling fairy dust this year.
Yeah, I mean, look, OpenAI now is one of the largest customers for Datadog, so almost 3 to 4% revenue customer. At the same time, Datadog's net retention rate, churn rate is so solid that I don't think it trickles down to other customers. It's not as if other customers will all develop their own in-house observability stack. So this is more of a unique OpenAI situation because of that $100 million bill. Maybe they are thinking of going public and they're cleaning up their costs, so that it doesn't stick out in the S1.
I am curious. I mean, as we talk about AI and, of course, all of the things that potentially will grow out of that, there's been a lot of talk about devices. What's going to be that big AI device? There was an interesting story a little bit earlier on the Bloomberg terminal, citing people familiar with this situation, that Meta was taking a minority stake in EssilorLuxottica, which basically makes, if you ever bought glasses, they probably were in some way or another made by Luxottica. It's only about a 3% stake, but it's $3 billion worth. And I'm curious, not so much as to what they're paying, but what's the end game here? Is this where Meta sees the future in eyewear?
Well, it's still less than the payment that they are making for the AI researchers. So clearly, it builds. But at the same time, look, Meta is looking to build that AI model that they can roll out across their family of apps, across their devices, the Ray-Ban glasses.
Didn't you have a pair of those?
I did, and it didn't work out very well for me.
Okay.
So for certain use cases, it works well, but I think I can't wear that for 12, 14 hours a day.
I mean, real quickly here, what do you think about the price tag, $3.5 billion? These days, we're not blinking anymore with these kinds of numbers.
Well, I mean, look, it's a minority stake, and the fact that Ray-Ban is such a big brand and they get to work with the company, I don't think it's that big of a deal when they are spending, like I said, $5 billion a year on the top AI researchers they have just hired. So
Can you dig into that? Because I really want to know the salaries and the bonuses that they're offering these people. Of course, the Apple's lead AI person going over to Meta, that was the reporting earlier today.
Yeah, I mean, look, it's not an exaggeration. They have actually paid up, and that will result in almost $4 to $5 billion in incremental OPEX. So when they report earnings, that's the one line item that I'm focused on is what does it mean for their OPEX rates?
Can they mark that down? Is that like depreciation or something. Or
maybe they announced a big layoff or restructuring. Who knows to offset that?
Today's job market is getting complicated. Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. We thank you so much for joining us here on set. Coming up, we're going to take you to the closing bell with Jay Woods of Freedom Capital Markets. Stick with us for that. This is The Close on Bloomberg.
I think 2Q is going to be really important because it's going to be the first real, time that we actually see the effects of tariffs. But expectations are really low. 2Q earnings expectations have been revised down. I think a lot of corporate America will show that they're much more profitable than expected.
Abby Yoder kicking us off to the close just about 50 minutes ago. S&P 500 has basically been unchanged pretty much for the entire day. You're seeing a little bit more activity when it comes to small and mid caps, Sonali, but right now, at least for today, not a market with a whole lot of conviction.
It's crazy. Underneath the surface, the churn is kind of wild. And the reason is you don't actually see the defensive trade as much as the tape on the index level looks like it would be otherwise defensive.
And I wonder if this is still maybe a little bit of trepidation about whatever's going on with tariff policy. I know a lot of people, they thought, okay, Trump would not follow through on this. I know he kicked the can down the road to August 1st from July 9th, but he kind of made clear in that cabinet meeting, at least if you take him at his word, that he's going forward with this, and August 1st, that's it.
Some have doubts, though. I'll point out Henrietta Trey's as one of them, saying that this is likely to go well past August. And, of course, there are the sectoral tariffs as well, some of which hit today. And on the heels of that, you do actually have the dollar back up a little bit. That's probably some relief for the market. But the 10-year yield, I think it's worth watching, 4.4% once again.
And we should point out that the majority of the stocks in the S&P today are actually in the green, despite the index being unchanged on the day. That's because you have some big drags to the downside from Amazon, JP Morgan, Alphabet, and Netflix. Jay Woods joins us right now. He's Chief Global Strategist at Freedom Capital Markets, joining us here in Studio 2 to count us down to the close. All right, Jay, let's start first of all with whatever's been happening over the last couple of days with trade. And it's hard to wrap my head around it. We had a headline earlier today about copper, 50% copper tariff. And my first thought was, didn't we already have tariffs on copper? But I guess he had only threatened them before, and now he's kind of saying, but it gets to this idea, and I don't want to make light of it, but it gets to this idea that the market seems to be having trouble just even keeping up as to what's up, what's down, what's being imposed, what's not. And I do wonder if that actually makes a case for certain people in the market just to not pay attention to it at all.
We're starting to tune out that noise which is coming from Washington. We're up 25% from the lows, which started on Liberation Day when that big chart came out and scared us to death. Down 15%.
The most expensive poster board in history.
Yeah, it was very clever. Whoever did that, give them some credit. But since then, we've made it all back. We're at all-time highs. So for the president to now negotiate at all-time highs, he's got some wiggle room there. So kudos to him for negotiating in public, but the market is not reacting to it. Yes, we sold off after a tremendous run to all-time highs, but the retracement was 1.5%. That's kind of a yawner. And then if you look at the activity, we're talking tumbleweeds this week after the 4th of July holiday. When WD-40 is the earnings that we're focused on, and Delta, yes, I know Delta tomorrow as well. It's a kind of a breather, and we were worried about what would come out of Washington. Yes, we went back to some of the levels. In fact, Japan went from 24% to 25% and went up. So these numbers are a little wonky. We have now to August 1st, we think. I think we'll kick that can down the road, as Sonali said. But right now, I think this is just a breather after a nice run, and I think we're set up and poised to go much higher as we kick off earnings season next week.
You think this earnings season that is about to kick off is going to be good, or at least it's going to be better than expectations?
Oh, without a doubt. I mean, the bar is low, as your last guest had stated as we came into this segment. And, what we have now are technical levels, which we're just breaking out above, and room to follow through. So that worst kick to the curb is over. Now we're digesting these gains, and I think the setups are there. And then the broadening of this market is what has me really excited, and my horns sticking out of my head on the bullish camp, because we're seeing more participation, and it's the right leadership. It's not just industrials leading us higher. Financials are coming back. Well, they'll be on display next week. And technology. So this is the right leadership.
Glad you brought up technology. Let's talk about a popular trade. Let's talk about NVIDIA. It is now at $3.9 trillion. According to our producer, Terrell Holt, that would make it the first company to hit that valuation. It's so close. Was it you that was obsessed with the $4 trillion mark? $4 trillion.
I already printed out my hats.
Okay, yeah. So
I need a hat.
Yeah.
So does that not feel frothy to you?
Not for NVIDIA. No, not at all. NVIDIA has been a stock that has gone sideways for over 12 months. It's a heck of a range, but when that stock consolidates like it had and then broke out above that 150 mark, the runway is long and it's launching. To me, yes, 160, I think 160.39 is $4 trillion. Not sure about the cent mark, but just over 160. We'll hit that $4 trillion. It will be a headline, but it's just starting to take off. The CapEx spend was there. I can't wait for the earnings come August.
163.94.
163.94?
Yeah, someone else did the math.
Well, then, I trust the Bloomberg staff. All right.
We got a whole team of people behind this
My
wall
intern
here.
is fired
They
right
do
now
everything,
because I was
so.
told 160.39. But yeah, I'd like to be accurate. So thank you for that on-air accuracy. But it's going to get there. So the question is just when. But when you talk about the tech trade, that was lagging Broadcom. CrowdStrike broke out. Micron coming back to life. Yeah. So NVIDIA just joined the party, but that's the leader you want. And yes, $4 trillion is going to be a milestone. Microsoft will probably follow in weeks to come. That's at 3.5, if I'm not mistaken. So have the producer check me on that, please. Yeah. And this is the leadership we want. So when you talk about NVIDIA, yeah, that excites me. We get to $4 trillion, but I think this stock could be a $200 stock at the end of the year.
I feel the bullishness, but my question is, where are the best places to hide? What are the safe trades in this market when the Mag 7 as a group is not even up 1% on the year?
No,
I mean, Tesla helped that out a little bit.
Well, Tesla is destroying everything, especially consumer discretionary, if you want to go there in a little bit. Yeah. But yeah, each stock is a little different right now, and they're telling their own story. I like how Apple and Alphabet are set up and poised to go higher, to rotate back into the other Mag 7 names that have been lagging. Apple, it's still above 200. That's positive. But Apple, to me, the story has changed until we can get that best next thing. But if it holds 200, technically, it's good, but it's still below the 200-day moving average. It's got room to go. So the Mag 7 trade, they're there. But where do you hide out? I don't think you want to hide. I think you want to participate on a broad-based platform. Where you want to go? The most beaten down sector, consumer discretionary, down over 2% year to date. Yes, Tesla's 4.3% of that. It would be up 2.6%. I did that math before I came in, so they can check me on that. But Tesla has been the one thing that's been holding it back, but it's still lagging. But when I look under the hood, okay, Amazon makes up 20% of it, and it's on its way to 240. But you look at Lowe's and Home Depot, they've stopped going down. They're starting to turn. The home builders, all of a sudden, they're gaining a little traction. Yes, that market is struggling, but to me, that's where you want to be. And then bookings. No one talks about bookings. 52-week high again today. This thing's a juggernaut.
All right, Jay Woods, always a pleasure. Chief Global Strategist at Freedom Capital Markets. As we get closer to those closing bells, you are seeing a bid in small cap discretionaries on this day. And as far as the S&P and the large cap names, you are getting a boost today from Tesla, from NVIDIA, from Chevron, and some of those big names. Unfortunately, that's being canceled out by a downdraft and some of the others.
Yeah, banks are down today, though, and yields are higher. We'll see where the trade goes.
A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak here to take you through that closing bell with the global simulcast. It has already started. There's Tim Stenovic in the radio booth, Emily Grafeo in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms. An unchanged day on the S&P 500, Tim Stenovic, but a little bit more activity in the small and mid-cap space.
Yeah, Emily's been talking about the Russell 2000 all day today. We are seeing some activity there. I think investors still have a lot of questions about tariff policy. I've been asking our guests throughout the day today, are these letters providing more clarity? And one after one, people are saying not necessarily.
You know, it's funny. I wanted to look at the Russell year to date, and the little bit of a bid you're getting today brings you to almost flat. Now, isn't that a fascinating stat?
Also in the commodity space, there has been some movement. Look at copper prices up over 9% right now. Of course, coming after that tariff news from Trump, potentially a 50% tariff on copper.
Yeah, and of course, I mean, the tariff news, I mean, we did see a big downdraft in stocks when we started to get some of those headlines. Some of that coming, of course, first from his social media site and then later at that cabinet meeting. And it really is just a reminder, Tim, of this idea that the tariff issue is far from resolved and still potentially poses a risk to the markets.
Yeah, I mean, I think that's what, you know, the big question people have is what does the August 1st deadline think? I mean, we speak to folks every day who basically say, well, he hasn't necessarily followed through on these tariff promises. And we just spoke to Chris Brigatti over at SWBC, and he was like, this is one he's not going to extend. August 1st, that is actually going to mean something.
And if you listen to his comments at that cabinet meeting, and I actually really encourage people to go back and listen to it. A lot of rambling, but in between that, he did make some very salient points about his philosophy on tariffs and trades, of course, hearkening back to President McKinley, and in his view, how that tariff situation, in his view, worked out. Let's take a look at the numbers across the board. Not a whole lot of action there with the S&P and NASDAQ. We're just going to call it unchanged. The S&P does have a red arrow, but only down about 4 points. The NASDAQ does have a green arrow, but only up about 6 points. The Dow Jones Industrial Average decidedly in the red, down more than 160 points or 0.4%. And the Russell 2000 decidedly in the green, up 14 points or 0.7%.
Still did have 269 stocks in the S&P 500 move higher today, whereas 231 moved lower.
Let's look at the sectors as well, because even though the sectors here show you a little bit of red on the screen, obviously it was enough to drag down the broader index here. You did have consumer staples, which was yesterday's gainer, and the relative safety trade in the market down more than 1% on the day. Utilities and financials also lower by almost 1% or more. Energy was your gainer. You had it up about 2.7% on the day. So very, very mixed trade, even though you had an index that showed roughly flat.
All right, let's get to some of the gainers today. I want to start with semiconductor stocks. I just went and chose the entire SOX, the Philadelphia Stock Exchange Semiconductor Index. We saw shares of semis rise today. The group outperformed as analysts expressed optimism about the group's prospects. Mizuho Securities raised its price targets on a number of chip makers. KeyBank Capital Markets also raised targets on a number of chip makers. If you look at the SOX right now, of the 30 stocks in there, 27 of them were higher, 3 of them were lower. Intel up 7.2%, Global Foundries up 7%. On the downside, Broadcom did fall 0.9%. Also, Emily mentioned copper stocks. I want to go with Freeport-McMoRan. The shares jumped as much as 8.8% earlier in the session. They moved lower after that Trump announcement at the cabinet meeting to finish the day finish the day higher rather by over 2%. This after President Trump said he would impose 50% tariffs on copper.
Did you know there are people who collect like old pennies, you know, the ones that actually still had copper in them because they were anticipating a big jump in copper prices?
You know, it's funny you say that. I did not know that.
Okay.
But I did learn something about coins today, and I'm glad you brought this up.
What's that?
Charlie Pellet told me that in the U.S., we do not have the actual number of cents that a coin is worth on that coin. Like a dime doesn't say 10.
That blows my mind.
A quarter doesn't say 25.
And I don't know why, but it blows my mind.
Hey, you know what? We're a little different.
Yeah,
we're a little different.
We are America.
We are. Hey, I want to end with a stock that really had some serious outperformance today. ProKidney shares soared the most ever. Look at this, up more than 500%. Isn't this wild?
I've never heard of this.
It's a drug developer. It gave top-line results from a mid-stage trial of its experimental therapy to treat kidney disease. The company reported statistically significant and clinically meaningful positive top-line results from a full Group 1 modified intent-to-treat population of a Phase 2 trial. And it was good news, and investors loved it. Look at this, up more than 500%, ticker PROK.
That is incredible, Tim. Let's go to the decliners, though. FICO, Fair Isaac, but known colloquially as FICO, fell 9% today after federal regulators said government-sponsored mortgage entities Fannie Mae and Freddie Mac will be able to use an additional firm when determining borrowers' creditworthiness. So they were using FICO. Now Fannie and Freddie will allow lenders to use Vantage 4.0, their credit score, to increase competition in the credit score ecosystem, at least according to what the regulators had to say. Vantage is a private company, so we couldn't see how the shares performed, but we did know that this was weighing heavily on FICO. I'm also watching shares of Hershey, down 3%, closing the day. Yeah, down about 3.2% after some management changes. The snack food company named Wendy's CEO Kirk Tanner as its CEO, replacing Michelle Buck. This is going to be effective August 18th. The reason why the street was so negative on this is that Hershey announced back in January that Buck would be retiring in June of 2026. And so the timing of the appointment is somewhat surprising, and the transition was almost a year early. So shareholders didn't like that. So we saw that stock falling. And then finally, First Solar. It's been a wild ride here for the solar stocks. Today we saw First Solar down, closing the day about 6.5% lower after President Donald Trump called for new rules that would restrict access to tax incentives for solar and wind projects that were already pared back in that big, beautiful bill.
Some of the big individual movers there when we talk about the aggregate market and the lack of movement that we saw in the S&P 500. I'll one-up you and take a look at the bond market. Treasuries basically doing nothing today. Yields are higher across the board, but only by about 1 to 2 basis points as you pick your point on the curve here. So a little bit of stasis, and we should point out most of the activity in the Treasury market actually came during the European hours here. So it's basically been stasis for the last couple of hours here on the U.S. side. Tim.
I got a little bit of a New York-centric story here, but there's a little technology in it as well.
Does it involve rats?
It doesn't. No. New York City is one of the biggest ride-hailing markets in the United States. And now, if you're in New York, you might start seeing Google's Waymo vehicles driving around because they're starting to test them here.
Oh, yeah?
But they have people behind the wheel. They're just gathering data.
Yeah.
The company sent out a social media post. They said, be sure to give us a wave and snap a pic if you see us in the city.
That's what they said? Okay.
And you're not just giving the Waymo a wave. You're giving the person sitting in the driver's seat a wave as well.
Do they know we don't give waves here?
Yeah, I was about to say, I mean, they're going to get a wave, but I don't think it's the wave that they're looking for.
Exactly.
So as somebody that drives daily in New York City, the problem is actually not the cars, right? Like, there's so many people.
It's the drivers?
And the people, right?
Okay.
I mean, jaywalking is a real thing in New York City. So it's a really interesting city to be trying this in. There are a lot of bikers, as you say, too. So again, I drive every morning in the city.
Can't trust those guys.
It's a lot to handle for a driverless car out there.
Yeah, I'm actually looking forward to this. I think anything possibly to improve traffic in this city, I'm definitely all for. I'm also keeping an eye on gold, Timothy. We were just talking about copper. But did you know that Tether, this is the big stablecoin issuer, basically one of the two big publicly traded ones out there, apparently they've been hoarding $8 billion worth of gold in a secret Swiss vault. And I'm glad it's secret, because if it was public, that would be trouble. But it really gets to this idea. This story really captured my attention because there's been all this talk about stable coins, of course, with Circle recently going public. And the idea that you can't have a stable coin unless it's, actually backed by real assets, presumably dollars, or maybe in this case, something that can be converted into dollars like gold.
But doesn't this answer a lot of questions about what was backing Tether or what is backing Tether?
Yes.
Hasn't that been a big concern?
It's been a huge concern for a while. And I think it's also when you look up the run-up that we've seen in gold prices, remember there was a big period where it just didn't make sense, economic sense, as to why you were seeing such a surge. And maybe this helps to start explain. And it might not just be Tether. There might be a lot of other folks out there that have been doing the same thing.
What happens then to the price or how much that stablecoin is worth if the price of whatever asset you have underlying it declines?
That's a good question. I don't know. Don't you host a crypto show?
I do. I was asking Sonali because she hosted with
right.
me.
We've seen depegging, but just another fun fact to leave in your minds, guys. Tether itself was the 7th largest buyer of U.S. Treasuries last year, even ahead of most major countries. And so safety, perhaps in gold as well as treasuries.
I have a question, though. If I buy a stable coin, does it say on the coin how much it's worth?
There's no stable coin. Oh, gosh.
There it is.
That's a joke.
Tremaine always brings it back.
That was good.
All right, we're going to have to leave it there. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We'll all be back tomorrow, same time, same place.
And our coverage continues here on Bloomberg Television with a deeper dive into the latest developments on the tariff and trade front. A conversation up ahead about some of the non-tariff trade barriers. Sara, Clinical Associate Professor of Supply Chain Management at the University of Tennessee, Knoxville, joins us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
And welcome back to The Close. I'm Sonali Basak.
And I'm Romaine Bostic. And Sonali, we had that big sell-off yesterday. It looked like we were going to get a rebound today, but ultimately what we got was a bit of a nothing burger. Take a look at the chart behind me, and you can see the S&P 500. You might as well call it unchanged, a red arrow to the downside, but only less than 0.1%. And we should point out that the trading range today was very tight, peak to trough. We're talking fewer than 30 points from peak to trough here. That's one of the tightest trading ranges that we've seen all year long. Also, activity in the Treasury market, somewhat subdued there as well, though we did see a lot more activity in the overnight session coming out of Europe. But once U.S. investors took charge, they basically said not a whole lot to do here on the day. There was a ton of activity, though, in the commodity space. Crude oil took a big jump up, largely on the a new report here about the potential for an increase in supply coming out of the U.S. and a huge surge in copper futures. This is COMEX, the ones that trade here in New York, $5.49 a pound. That's a record high, Scarlett. Excuse me, Sonali.
It's okay. We're like sisters. I'll take it. Well, a few equity movers we're watching today here, Romaine. Some of the day's biggest movers. SoFi was an interesting one, up about 3.7%. It's like the fourth day of gains, so pretty interesting moves over the longer term. Now, the tax bill is set to help companies that offer private student loans, which is still a big business for SoFi, although it has been diversifying. Also watching Intel was up more than 7% today. It was soaring. The company, though, is planning to cut 500 positions as part of a layoff plan that should help them reduce operating expenses. Also keeping an eye on Amazon because it was one of the big tech giants that had been declining today to the tune of 1.8%. On the first day of Prime Day, sales fell almost 14% in the first 4 hours, and that comes out of concerns that tariff pressures are offsetting discounts. So perhaps things were much cheaper last year on a day like Prime Day, or one of 4 days, than it was this year around.
And that brings us to our top story, Sonali, for this hour, and that really is a closer look at U.S. trade policy and the impact on global markets. The parlor game among investors for weeks has been a bet on whether Trump's bark would be worse than his bite. For now, he's still barking, but with no meaningful trade deals ahead of the July 9th deadline, now extended to August 1st, the president tried to make clear today that he is indeed ready to bite. Threats to a wide range of countries to get them to the table, combined with separate threats of 50% tariffs on all imported copper and 200% on pharmaceutical drugs. It signals a hardened stance, a stance that is not just confined to tariffs specifically. Non-tariff trade restrictions also vexing markets, including in the chip sector, as the Trump administration just a few days ago said it would stick by plans to restrict exports of AI chips from the likes of NVIDIA. In fact, South Korea's Samsung Electronics overnight warned investors of a sharper than anticipated 56% plummet in operating income for the most recent quarter, which it blamed on inventory write-downs following U.S. curbs on Chinese-bound AI chips. Joining us right now to talk a little bit more about this is Sara. She's Clinical Associate Professor of Supply Chain Management at the University of Tennessee at Knoxville. All right, Sara, there's so much now batting around the chip sector, from actual tariffs to some of these sort of non-tariff measures. And I am curious as to whether you see an industry that is actually prepared for the idea that the U.S. will indeed follow through on all of these threats.
I think it's going to be, it's really going to depend on which specific industry has to deal with these threats. We're looking at potential restrictions on semiconductors themselves, but this would also potentially affect other elements of the supply chain, both upstream and downstream. So for things like consumer electronics goods, that could also increase the prices of those because semiconductors are critical elements of those. For the semiconductor industry, I think it's going to impose additional cost and potentially reduce profits.
Well, this is what I'm curious about, too. And we've had you on this program a lot over the last couple of years to talk about supply chain issues, obviously first more related to the first trade war, then COVID, and a lot of things in between. In the semiconductor space, I mean, I don't know, maybe this is an overstatement, but it is truly global in the sense of how these things are made, where they're sold, and how they're bought. And I am curious, is there a realistic way of kind of decoupling from a global supply chain for semiconductors to something that is sort of confined within the borders of, one or two nations?
Absolutely not. And that is a really critical point. The issue is that, with the tariff, the Section 232 investigation in particular, that was initiated by President Trump in April, looking at potential 25% tariffs on semiconductors, we were also potentially examining imposing tariffs on the upstream suppliers. So things like wafers or chemicals or equipment. That means that for companies who are setting up shop in the U.S., like TSMC, Intel, Micron are both expanding in the U.S., they would face increased costs from the get-go. And in addition to that, I know Section 232 has also been looking at potential tariffs on the downstream. So looking at potential increase in the prices of consumer electronics as well. So really, when you kind of attack the whole supply chain, when you increase prices across the whole supply chain, at least for a large chunk of it, that's hard on consumers and on businesses alike.
Sara, what does the supply chain look like in terms of, you mentioned this could get worse for consumer electronics. I'm very sorry to say, I'm one of those people with a very broken iPhone. It's very embarrassing. I have been waiting about 6 months to get a new one, and I just haven't gotten around to it yet. And, I wake up every week and I'm like, well, do I wish I bought it 2 months ago, right? But it takes a long time to get there, doesn't it? So when do consumers actually start feeling the pinch?
It's really hard to say when these tariffs or non-tariff barriers are going to take effect. Section 232 investigation is ongoing, I believe, until the end of the year. So far, semiconductors have been generally exempted from the reciprocal tariffs. If they are not, and if the, like I mentioned, the upstream and downstream with the materials used to make semiconductors and the electronics, if those are not exempted, then we're going to feel the pain even sooner as these reciprocal tariffs come into effect, potentially August 1st. And so, that is, it's also going to depend on the product, to what extent they use items, components that are heavily tariffed. So every single producer is going to have to look at their bill of materials and figure out to what extent that's going to raise their own cost structure.
What about the sectoral tariffs? To Romain's point, you have an industry like consumer electronics, semiconductors in particular, that's very obviously global. But then you have sectors like housing, where the 232 tariffs on things like lumber could create a really big rift in terms of the home building supply in a very sensitive market already. How do you think about some of the areas that are not as obvious today, given that those 232 tariffs have not really seen the light of day yet?
I mean, I think that there is a lot of fear in the marketplace, and we have seen some prices, such as prices of lumber and other types of building materials, already increase in anticipation of some of those price hikes. I have heard about potential price increases in those higher level semiconductors as well, in anticipation of potential semiconductor price increases. So there's, as you guys talk about a lot, there's a lot of uncertainty in the market, and so businesses are really just trying to hedge their bet. Also, they're trying to build up inventory of critical inputs before all of these things come into effect.
Sara, we thank you so much for joining us today. That is Sara Hsu, Clinical Associate Professor at the University of Tennessee at Knoxville.
I have one more question, Shanali, and that really was, what exactly did you do to your phone to make it liquid? Were you throwing it at the wall or something?
I'm very awkwardly an abrupt person, super clumsy off air. It's very unfortunate.
Okay, all right.
I was trying to make myself vulnerable to our audience. I might regret that later.
No.
Don't get in the crosshairs. I think that's the story.
You got to get you a better case.
That's true. The OtterBox failed me. Coming up, we're going to talk about the market impact. We're going to bring in Matt Miller and Miller Tabak. Of course, the tug of war you're seeing in the tariff strategy. Matt Maley joining us next. Stick with us. This is The Close. Goldman Sachs, Bank of America hiking their year-end S&P targets today despite market uncertainties surrounding tariffs. Our next guest, though, has not ruled out the possibility of more trade-fueled headwinds for this market. Joining us now, Matt Maley, as we promised, Chief Market Strategist at Miller Tabak. And this is the kind of analysis I've been looking for. I feel like so many people have been looking through the uncertainty, gotten used to the uncertainty, have ridden the wave higher since the April lows. But to the extent that there's still risk here, near record highs, where's the biggest risk?
Well, I mean, there's two of them, I guess. Number one, of course, is this whole thing with what's going on with the tariffs. You know, we've overcome so many different headwinds that could have caused the market to get knocked down this year, except for the tariff issue. And of course, that knocked it down quite hard several months ago. And now we have this new situation where, I know President Trump is push things off for another couple of weeks to the beginning of August. But he has a lot more leverage than he had to be much tougher. I mean, we're not going to go back to the proposals we saw, after Liberation Day. But people forget that the bond market was basically in free fall. There was forced selling going on in April. They had no choice but to back off. Now, with the markets calming down, both the bond market and the stock market back to a new high, we have, he's got past his budget bill. Obviously, in the situation in the Middle East, which he had a hand in, has given him, all sorts of leverage. And we know that this tariff issue is not something he just dreamed up when he became president. He's been talking about this for decades. So I think that those who are going to think it's going to be that this taco thing is going to continue might be a little bit disappointed.
I am curious, Matt, what you think about the idea that over the last few days, last few sessions, we did see some relatively meaningful outperformance by small cap companies, cyclical companies relative to the larger cap indices. And I'm wondering what message you think that's sending. Is that a commentary on the economy, a commentary on trade policy or the lack thereof, or is that simply maybe just people bottom fishing it for valuation?
I think it's the latter, the bottom fishing type thing. I mean, don't get me wrong. You're absolutely right. The small cap names have seen some nice resurgence here. And on the technical side of things, it's trying to break out. And if it does, it's such a momentum-based market right now, it could see, some more movement. But the one thing, though, is that we know that these tech stocks are absolutely the clear leaders. I mean, no matter, we like to see this talk about rotation. But if the tech stocks start to roll over, and it's one thing if they're going up more gradually than they had been, but they can't roll over because they're too highly weighted in the indices. And if those things start to fall, that money starts to get pulled out of the market and creates problems. So I know that right now that people are like, oh, don't worry about it. You were just talking about the chip stocks. There's some issues starting to build up there. It could create some problems.
The 10-year is getting pretty close to 20 basis points higher than where we were at the beginning of last week. Now, we are well off the highs, but what is that telling you? And is there more risk in the bond market that might spill over to the equity market?
Well, it goes back to this whole issue of the budget. And, we're hearing a lot of people talk about, the market's already priced in that I don't see that at all. I mean, I do realize that for decades, people have worried about the budget and it's turned into nothing. But this year, we are starting to see it, not just here in the U.S., but in markets around the world. So if we see any kind of push higher here, that has to have an impact on interest rates. I realize that they're not as high as they were in the 1970s, but when you have a stock market that's trading at 22 to 23 times earnings and more than 3 times sales, at some point that has to have an impact. And so I just think the complacency that we're seeing right now is getting a little too much for my cup of tea, I guess.
All right, Matt, got to leave it there. Matt Maley over at Miller Tabak. A little closer look here, I guess, at a market day that really wasn't much of a market day, Sonali, but of course that could change. A market still camped out near record highs.
Well, think about it this way. You don't need to worry about July 9th as a deadline.
Yeah, now you just have to worry about August 1st and bye-bye, your summer vacation, potentially. We say bye-bye to Sonali. We thank her for joining us here on The Close. Our coverage, though, rolls on with Ralph Schlosstein, Chairman Emeritus at Evercore.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that, they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
The twists and turns in President Trump's tariff negotiations continuing today. The president earlier at a cabinet meeting at the White House saying he would slap the 50% tariff on copper and maybe as much as 200% on pharmaceuticals, as well as more tariffs on the chip sector. Of course, no real timetable for when that might happen. But again, the threats alone having a big impact on the market. Joining us right now to talk about where things stand right now in the market, particularly with the intersection of everything that's going on in Washington, is Ralph Schlosstein, Chairman Emeritus at Evercore ISI. Great to see you, Ralph.
It's great to see you.
Where are we going on tariff policy? Let me rephrase that. Not necessarily where we're going, because I don't know if anyone knows where we're going. But how do you think the market is digesting all of these policy shifts, the ups and downs, and at least right now, a lot of things that Trump has threatened haven't actually been implemented?
Right. I think, first of all, your introduction was perfect, twists and turns. Mm-hmm. And I think what's happened is the market has gotten so accustomed to twists and turns that when there's a twist that they don't like, they assume a turn that will be more benign is coming very shortly. What we need more than anything else is a settling down of this so that what I believe are pretty positive forces in our economy can take over. And I think that generally would be pretty positive for the market. But right now, the volatility is very painful.
Well, that's what I'm curious about. Are you of the mindset that, A, the volatility might actually start to tamp down a little bit, presuming that we do get a little bit more clarity as to what tariffs are going to be, what level they're going to be at, who's going to be impacted by them?
Well, I take a little bit of I'm looking through the twists and turns at the moment, and there are a couple things that I think are really important. Number one, we are, first of all, the economy is in pretty good shape.
Yeah.
Unemployment is quite low. Employment is steady. Inflation is gradually drifting down. There doesn't seem to be any significant pull through on inflation from the tariffs that have been put in place so far. So there's a lot of underlying strength. Then you put on top of that, we've just had passed and signed by the president a very stimulative fiscal policy. So the next 6 quarters, 8 quarters, 10 quarters, there's going to be a wind at the back of the economy. You add to that the next move in interest rates is almost certainly down. And so you have a increasingly accommodative monetary policy. You have a supportive and, in fact, stimulative fiscal policy. So once we get through this period of volatility and uncertainty, there's some pretty strong tailwinds behind the economy and therefore behind the markets.
You mentioned interest rates. You think there is an economic case to start cutting interest rates soon, meaning sooner than later?
I think the Fed is absolutely correct in waiting until there is a little bit more evidence as to either a little bit more weakening in employment or a little bit more reduction in inflation. There is no cost to waiting right now, and particularly when, the Fed did kind of blow it a little bit on transitory. And so to be premature in cutting rates when there's still inflation above their targets. And I'm a believer that we'll have a couple cuts this year. And if you ask me the probability of 3 versus 1, I would say the probability of 3 is greater than 1.
Well, the president, of course, continues to exert as much pressure as he can. And I want you to listen to something that he said about this a little bit earlier at that cabinet meeting.
He should resign immediately. We should get somebody in there that's going to lower interest rates.
Do you want congressional
Why don't
Republicans
you call for his resignation?
Do you want congressional Republicans to investigate and pursue?
It's okay with me. I think he's terrible. He's always late. But he wasn't late with Biden before the election. He was cutting him like crazy. It didn't help too much, did it?
All right, so Ralph, I mean, cutting through some of the hyperbole and the asides, there is a question here about what the next Fed chair is going to look like. One way or the other, Powell is going to be gone within a year's time, whether it's earlier than that or in May of next year. And it gets to the question as to who would you like to see fill that role? A lot of names that have been bandied about, Kevin Warsh, Waller, a few others. Obviously, Trump is going to lean towards somebody, presumably, that he thinks is going to be a little bit more dovish than his perception of Jay Powell.
Yeah, I think that, well, first of all, let's not forget that Jay Powell, who the markets are venerating right now, was appointed by Donald Trump. Yeah. So he has a history of appointing people who are actually well received by the markets. The people that you've listed as a general matter, I think would all be pretty well received by the markets. And I think once you sit in that seat, first of all, your job is to build consensus among 12 members of the Open Market Committee, the 7 seating governors and 5 from the regions. And one does not do that with bombast and with pounding the table for one view when it's out of touch with the economic realities.
But do you think Powell's done a good job? I mean, he was well received by the market, as you said. And I mean, there were some concerns when he came in because he wasn't like a traditional economist. But for the most part, it seems like the market warmed to him pretty quickly. They've been relatively happy with his guidance. I mean, I know they made some mistakes on the transitory side, but you were if I remember correctly, back in, 2017 or whenever, you were relatively supportive of his nomination.
I'm supportive of his nomination. I think he's, in large measure, done not a good job, but an excellent job. I really do. And not always in the easiest of circumstances. And by the way, there were plenty of other people, not at the Federal Reserve, who thought that the COVID-induced inflation would disappear very quickly and would in fact be transitory. So, and once it became clear that that was not the case, I thought the Fed moved incredibly aggressively, and the victories we're having in inflation right now, and the fact that we have not had a recession, is a pretty strong tribute to their policy.
I am curious with regards to policy, and I guess more importantly, politics. You mentioned the budget and tax bill that was recently signed by the president, something that, of course, members of Congress as well as members of the administration are going to go out to the public and sell. The market, to a certain extent, likes it. I guess the question is, do you think this is something that's going to have resonance with rank and file voters as we head into a midterm season next year?
Well, this bill continues a lot of benefits for people like myself at the expense of people who are living from hand to mouth, paycheck to paycheck, and who are dependent upon the federal government for health care and for food. I don't believe that is particularly resonant with the voters at large.
I am curious as to what you think about the voters at large. We just had a mayoral primary here in New York. Zoran Mamdani, Democratic Socialist, won the primary, still got a long way to go before actually becoming mayor. But there's been a lot of discussion here about this move to the further left by the Democrats as maybe a potential counterpoint to this big move we've seen to the far right by the Republicans. And I am curious if you think that people like Mamdani are maybe the answer for Democrats, or are they looking in the wrong place?
Well, first of all, elections are not only about the respective policies of the 2 candidates or 3 candidates or 4 candidates, but also about their energy and their leadership skills and their personality. So I think, in my own view, and I could be wrong, Mamdani's win was as much a repudiation of his primary opponent, who barely campaigned and didn't show up to some of the debates. And Mamdani did something that's really important for the Democratic Party. He increased turnout on the part of those 25 to 35 by 30%. Very high enthusiasm. So we got to bottle that. My guess is if you lined up his policies and those of more centrist policies in a blind taste test, the majority of people would support the centrist policies.
Oh, yeah.
However, something that he has gotten very right and that the Democratic Party has to focus relentlessly on is affordability. People, the vast majority of people in this country are not benefiting from the extraordinary performance that we've had in our economy to the extent that the top people are. And that has to be fixed.
And that's a nationwide issue. And some people would say almost directly responsible for Trump's ascent, because he really tapped into a lot of that angst that we saw across this country of people who felt that same way.
Yeah, and remarkably, his policies aren't particularly responsive to that angst, but he still, has some popularity.
When you hear a lot of, I mean, obviously there are a lot of folks on Wall Street, a lot of wealthy people in New York who, when they see somebody like Mamdani and the prospect that he might be mayor, they're all saying, okay, we're going to, depart and go to Florida or Texas or wherever. And I know there are a lot of folks who say that and don't really follow through in that. And New York will always be New York City, the financial capital of the world. But do you see any threat to the city standing as being the financial capital?
Well, if you're the mayor of New York City, you care about a handful of things, and you care a lot about them. You care that there are a lot of jobs here. So being anti-business, anti-capitalist is not a good spot for a mayor to be. You care that housing is plentiful and affordable, and 100 economists out of 100 can tell you that if you cap rents, people don't build housing. You care about education, which unfortunately has not been discussed hardly at all in this campaign, and to me is the principal source of upward mobility in our society, and we're not doing a great job educating the 900,000 students who are in our public school system. And you care about public safety, obviously. So it's a little bit like the question you asked me about whoever sits in Powell's seat. Once he she sits in Powell's seat, there's a certain collegiality and the president appointed you, but you're going to do what you believe is right. Once you sit in the mayor's seat, you're going to do what's right for this city on those four things that are fundamental to livability here.
A loaded question here, but why didn't you ever pursue politics?
Well, I spent the first 7 years of my career in Washington as an economist on the Joint Economic Committee in Washington, in Congress, and then 4 years working for President Carter before you were born in the White House. And when I was in Washington, there was a solid core of Democrats and Republicans who would always do the right thing for the country. We've lost a fair amount of that. It's very tribal. If you're either with me or against me, you're a Democrat or Republican. And there's still people, I think, who believe in that. But unfortunately, in both parties, they're disappearing. I mean, look at Tom Tillis. Sad.
Do you think there's any hope, though, that we can maybe get that back? Or what would it take to get that back? Does it have to be some catastrophe?
Well, the challenge we have is that in the vast majority of elections in this country today, not the presidential, but in most senatorial and congressional elections, the primary is the election. So Tom Tillis could probably get reelected if he got the nomination. But if Donald Trump puts a conservative candidate against him in the primary, he might lose. And that's a very sad thing.
All right, Ralph, we have to leave it there, but maybe potentially we have a little bit more optimism for the future. Always a great conversation. Ralph Schlosstein there is Chairman Emeritus at Evercore. All right, we do have some breaking news crossing the wire. This on Apple. Their longtime COO, we have learned, is now going to be stepping down. Jeff Williams is going to stick with the company, but the role is now going to be handed off as COO to Sabih Khan. This now is going to be part of a newly reorganized team that Tim Cook is putting together, a design team that's going to transition a lot more of the reporting directly to Tim Cook. We're going to keep an eye on this story here as that company tries to navigate its future. Stick with us. This is Bloomberg. Back to that breaking news. Apple changing chief operating officers. Jeff Williams, who's held that role for more than 9 years, is going to step aside in favor of Sabih Khan, who was vice president of operations, basically the man who oversaw Apple's global supply chain for the last few years. Williams staying on at the moment. Tom Giles joins us right now, who helps to lead our global technology coverage. And Tom, there's been a lot going on with Apple. A little bit earlier in the day, there was a report on Bloomberg how Meta had poached one of its top AI executives. And now here, a reshuffling at the COO role, a very important role, of course, because that was the former role of Tim Cook.
Sure, yeah. And at this stage, we have no reason to believe there's any connection between these two things. So I want to just set that, set the record straight on that at the moment. Some very big, important moves in Apple. As you point out, Jeff Williams had been the COO for several years. Apple characterized this as a long-anticipated set of changes. Jeff will be retiring from the company later this year. For the time being, he still retains oversight of design and Apple Watch, really important divisions of the company. But, you know, they are bringing in somebody new as COO. This is somebody who he's senior VP of operations. You will remember that that before Tim Cook became CEO, he was the operational genius behind creating the supply chain that really catapulted Apple into this, you know, one of the world's largest, most important, most valuable companies. The people who do operations at Apple have a very, very important job. And clearly, the new COO, who's just appointed, has demonstrated his mettle, his capabilities in this regard, or you wouldn't see Apple putting him in this, you know, in this role with this much responsibility.
All right, Tom Giles helps to lead our technology coverage, a closer look at the new COO of Apple. We'll try to get a little bit more information here as to exactly what drove that decision, but no real movement in the shares in the after-hours trade. We did mention in that conversation that earlier in the day, we did have a report on Bloomberg about how one of the lead AI engineers at Apple is poached by Meta. A lot of questions out there right now about the build-out of AI, the spend on AI, and more importantly, how AI will maybe be complementary or, I don't know, maybe antagonistic to workforces out there as they adopt it. A slew of executives have sounded the alarm on artificial intelligence on that front. From Amazon to Ford, the CEOs warning that AI could eliminate some of their workforce. However, our next guest says that narrative might be a little bit overblown. Jason Warner is the CEO and co-founder of Poolside, a startup that's building artificial intelligence software for programmers. And, well, he sees maybe a little bit more of a silver lining in this whole AI build-out. Jason, great to have you here on this show. I know there's been a lot of gloom and doom, and more importantly, a lot of talks about the extremes. Either AI is going to be the greatest thing since sliced bread, or it's going to be the thing that kills us all. And I know there's a lot of nuance in between that. When it comes to the workforce and the idea of whether AI is going to take my job or it's going to be sitting beside me, helping me do my job better, you think it's going to be the latter.
Absolutely. And again, thanks for having me. And in how you just described it, it's a perfect representation. You find yourselves in this conversation at extreme ends of the spectrum, and the middle is where we're going to find most of this nuance and the truth. And if for artificial intelligence and neural networks themselves, they're the massive augmentation that's about to happen to us, and they're the largest augmentation that's going to happen to humans in this space. But if we think about them as replacing us, that's a fool's errand. If we think about them as bring about our doom, that's also not what's going to happen. The answer is always a little bit more mundane than we want it to be.
And at least what you're referring to, we're primarily talking about white-collar workers here. And we've talked about this a lot on the program, and a lot of people have used analogies in the past, like the advent of the computer age in the 60s and 70s, and obviously the internet boom in the 90s, and that which all sort of promised to eliminate a lot of jobs. And it did eliminate jobs, but it also created a lot of jobs as well. In fact, we have more jobs today on a per capita basis than we did back in those days.
That perfect analogy. Perfect way to structure this conversation, which is whether you look at it as, will my job change or will society writ large be changed by this? And both of those are likely true, but in ways that are going to be approachable to folks. What really is happening here is that the pace of change and innovation is going up and up and up. Things are happening faster, and that's hard for us to consume as a society. But as society goes, we are largely going to see way more jobs created in the future. We're going to see our individual job functions change 100%, yes. But the tasks that we start to automate with neural networks and artificial intelligence does not necessarily mean that whole sectors of society go away. In fact, I think it's quite the opposite.
Well, I am curious, too. I mean, let's take something like just software coding. I mean, obviously, this is near and dear to your heart based on what Poolside does. I mean, that was sort of one particular pocket that I think a lot of people were worried about. This idea that coding can be a very rote process for humans, and the idea is that that could be easily transferable to some sort of automated, some robot, if you will, for lack of a better term.
Well, I think software is probably the most perfect use case currently that exists for artificial intelligence. And it's also a great representation because at one end of the spectrum, it's a massively creative endeavor. And at the other end of the spectrum, it's also incredibly rote and laborious. Things must be structured in a certain way. You must do things to adhere to certain system protocols and APIs. But it doesn't mean necessarily that the creativity is going to be pushed out of the task. So what will happen is that software developers will continue to exist, and they will always exist. The form and function of the job does change. The tasks that a developer does on a day in, day out basis, some of those will remain, and some of those will be done by a neural network or artificial intelligence that sits beside them. And this is incredibly important to understand. It's just not that we're going to get rid of software developers or get rid of any function, but what we will see is that the jobs that they do day in, day out will start to become automated. So the tasks that happen inside there.
Yeah, and we were speaking a little bit earlier on this program with Scott Dresser, who runs the robotics program and over at Amazon, and we had the same conversation. The idea that when they bought the company that he used to work for, Kiva, and they introduced those robots, the same gloom and doom came in, but of course those robots ended up augmenting the humans who were there on the floor. There is, though, a psychological issue with human beings, as I'm sure you know. This idea that we are resistant to change, particularly when that change comes all at once. And let's face it, I know AI isn't new, but for the general public, it is new. They had never heard about this stuff 3 or 4 years ago, and all of a sudden it seemed like it was everywhere. And as an old colleague of mine used to say about financial markets, is not necessarily what prices are, it's the rate of change that tends to spook people more than anything else.
I think that's exactly what's happening here. It's the rate of change. And when we think about what's happening is the pace at which we start to see these artificial intelligences improving, these models improving, it's a little disorienting for folks. And the only thing they can do is extrapolate out saying, well, this is something that I've defined myself with and by for some period of time. And now it looks like there's something else that's going to be able to do that at least as well as I'm able to do it, if not better. And I think that a good example of this would be in software development. There's a task that you need to do, which is you need to write the actual source code. And that involves writing lines of code. And those lines of code tended to have been either memorized or you could have some loose understanding of what the APIs for the various programming languages are. Well, artificial intelligence can do that better than us. So that doesn't mean software developers go away. It just means that thing that you started to define yourself with needs to change. Your relationship to that specific task needs to change. And I fully recognize that it's disorienting to folks, and the pace at which it's happening is the fastest that we've seen in history, in my opinion. But it doesn't mean that we're going to see entire sectors go away, as I mentioned.
All right, Jason, I have to leave it there. Great conversation. Jason Warner, CEO there and co-founder of Poolside. All right, as we close out the show, a quick look at what to keep your eyes on as we push ahead over the next 24 hours. That includes some CPI data coming out of China. That comes at 9:30 p.m. tonight, and at 10 a.m. tomorrow, we get wholesale inventories out of the U.S. and a big event for Samsung Samsung as they unveil the latest additions to their Galaxy portfolio, and FOMC minutes. That's coming down the pike at 2 p.m. Eastern Time, a read on what exactly transpired in the last Fed meeting. And of course, we will have full coverage of the Sun Valley Conference going on out there in Idaho, an eye on what deals may happen and what deals may not. Thanks for joining us on The Close. We'll be back tomorrow.